Brent, we got Travis on the line. What do you want to ask him?
I guess if there was one thing that you could tell yourself 15 years ago before you started to kind of progress your path faster, what would it be?
It's mentors, which cuts the learning curve tremendously. And the best advice I ever got from a mentor was double down on what's working. So between high school and post-college, I'd probably launched 20 small businesses of different types. They were all suffering because I was not good at what I was doing. And when I got into real estate, it was the first thing that just clicked. It just made logical sense. It made fundamental sense. I could touch it, feel it, see it. It was the first thing that really was working. And so I doubled down on it. I made that my full-time focus.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and inspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. We've got another great show for you guys today. We got an experienced investor with us, Travis Watts. It's his second guest appearance on this show, and Brent Ufkes. So, gentlemen, welcome to the show today.
Great to be here, Brian.
All right. Well, Travis, you're up first. Let's talk a little bit. So, how you doing, first of all?
Doing great, man. Excited for Best Ever coming up. I don't know when this podcast is going to release, but big conference that you and I usually run into each other at every year, and helping Ashcroft Capital, Joe Fairless, kind of build out the team. And we continue acquiring through these crazy times and doing well, man.
Yeah, I think that was the last time. It's sad to say it was last February or March. I don't remember when exactly it was, but I think that was the last time we chatted. So glad we're getting together this time, and I will see you there this year as well. So let's start by having you tell us a little bit about yourself, give us an idea of your background and what brought you into multifamily.
Sure. Yeah. Happy to share. I'll take this in a story form in a different way than I normally do. So when I was in high school, so my parents split when I was 5 years old. I was visiting my dad one summer, and he's a big garage sailor. And so he picks up this random book called Rich Dad's Prophecy. So it was maybe the third, fourth book that Robert Kiyosaki had made after Rich Dad, Poor Dad. And this is at the time where I'm going into college. We're talking around the time of the Great Recession. And that book scared the crap out of me about the stock market in general, the volatility. And, he claims the biggest stock market crash is coming and all this kind of stuff. So I went into cash, what cash I had saved up from jobs and miscellaneous in college. I just went to cash, and this was right kind of nearing the peak. And I wasn't trying to time the market, and I wasn't nearly smart enough to know anything. Arguably, maybe the author wasn't either. But anyway, that's the decision that I made. And I didn't know what I wanted to get into, but I didn't like the idea of the ups and downs. And sometimes you just lose half your money, and that's the way of the game. So it took me probably 5-6 years after that point to dive into real estate. And so I got started with single family homes like a lot of real estate investors do. First, I just had a roommate in the home that I lived in. And that was my first experience to passive income, right? Somebody handing me a $600 check every month, and I didn't have to work for that money. So I thought, man, how do I scale that, right? How do I take this $600 check and times that by 100, And so that got me into some fix and flips and investing in the way that most of us were taught, which is buy low and sell high. I learned a lot of lessons from that, and there's nothing wrong with buy low, sell high. Still use it today to an extent, but it was the passive income that I really started to focus on and hone in on. And so then that led to vacation rentals. That ended up leading to multifamily syndications. And then from there, I've just broadened out even further with car washes and self-storage and mobile home parks and publicly traded REITs and ATM machines. And there's so many things that you can do to generate passive income. And what I was really trying to accomplish in the beginning was leaving my job. I worked in oil and gas, 14-hour days, 98 hours per week, 2 weeks on, 1 week off. It was crazy. Always out of state, away from home. Saudi Arabia, I worked everywhere. It was at the time that I thought, what if I liquidated my assets and paid the taxes, and what would I be left with? This is the first real net worth conversation with myself. And I said, what if I started trickling that money into these syndications, right? Just 50K here, 50K there. I realized that would give me generally enough passive income to leave that job and then to go pursue other things that I enjoyed more. And so that's exactly what I did. It took about 2 years to unravel all of that.
Yep.
And so it led me into a full-time investor situation where I wasn't ready to quit work. I didn't want to retire in the traditional sense. I just wanted to pursue things that I was actually interested in. So the first was, joining the Wall Street world. I went to go work for a huge brokerage firm and got licensed. And I thought maybe I should learn stocks, bonds, and mutual funds too, so I'm not so biased on real estate. And then ended up leaving that shortly after when I realized the system and the lack of alignment there, and moved back into real estate. And so helped a couple small syndication groups kind of work out investor relations portions of their business. And one of the groups I'd been investing with for years was Joe Fairless and Ashcroft Capital.
Yep.
So I joined their team, helped them build out investor relations, and now I do investor education. And so my passion has just become educating others in the space of building passive income and investing in real estate just in general from a macro level. So that's kind of how that unfolded in a very strange way.
Yeah. I love the story. And something I'll point out that, I probably should have started a long time ago is you said at one point that you started focusing on passive income. And I think too few people do that. I think a lot of people are focused on other things, or they fail to focus on passive income. So how you said it took about 2 years for you to, I guess, divest a lot of stuff and put a lot of things into syndications. How long were you passively investing in real estate and other asset classes or asset types before you started coming in on the GP side?
Yeah, good question. So I never came in on the GP side. So I went from full-time active individual investor to full-time LP investor with other people in other deals. So diversified among maybe 15 different operators and 50 plus deals as a limited partner. And a lot of this had to do with the pain points I was experiencing of being active myself. I was burning out because of my career / trying to build up single family homes and do everything myself. So nothing wrong at all with being active. And that's what I definitely want to jump into. There's so many pros to it. But for me, I like to travel. So does my wife, and we historically have moved quite a bit just to experience different, ways of living and stuff. And it was always something about being so overly active that just kept me grounded to one spot. We couldn't take off on a trip. We had to cancel a lot of things, and we just couldn't really visit even with family and stuff like that. So we did it for lifestyle purposes, just to give us that flexibility. That
resonates with a whole lot of people. They want the lifestyle. They don't want to be tied down. I think most people who come on the podcast, that comes out in some way, shape, or form. Now, you mentioned you started working with Ashcroft and Joe Fairless. How did that come about? And give us a little more insight on your role there.
Yeah, it was a funny story. So I had wrapped up kind of my contract, so to speak, with a smaller syndication group out of Colorado. And I was brought on to help them build an investor relations platform and hire some people to run it. So kind of been there, done that, took about 2 years or something. So I was at a crossroads where I wanted a new challenge. I wanted a new project, and they didn't really, need me, quite frankly, at that point. So I reached out to Joe, I believe it was on a Saturday. I just pulled out my phone and I just started shooting this video just raw. And I was like, Joe, it's me, Travis. You know me. I know you, one of your investors, blah, blah. Love what you guys do. Love the business model, the team, the communication. I said, I just wrapped up doing this whole IR project, and I'd be happy to come on board and help you out if I can help in any way, shape, or form. Give me any title. Pay's not the objective here. It's just, adding value. And it was funny. He was so grateful and appreciative. Anybody who knows Joe is like the most humble guy you'll ever meet. And he's like, man, that was so nice and out of the box. But unfortunately, we just don't have anything for you. We just don't have any openings like that. So I sat, for about 2 months thinking, what are my next steps? What am I going to do? And out of the blue, he emails me and says, just so you know, we're hiring for a director position for investor relations. And it's a lot of the things you told me you wanted to do, such as attending conferences and doing webinars and doing podcasting and networking. And I thought that's perfect because I'm going to these conferences anyway out of my own pocket, flying around the nation, trying to meet people. I can affiliate that, through a group that I know, like, and trust. Right. So he brought me on to do that. And that was in 2019. And then fast forward through today, we've hired 6 or 7 IR reps, and we have a whole investor services team on top of that, a whole marketing team and marketing channel. And then I was able to finally switch over to my true passion, which is helping educate people. And so full time now I'm doing, steakhouse dinner talks. I'm on stage at, Best Ever Conference and conferences like that, webinars. I run 3 different podcast series, and I write a lot of blogs and content for our newsletters and for online social media. And that's just what I love doing. It's a creative outlet for me. I'm convinced these are things I'd be doing, without pay. It's just where I want to be right now in life. So that's kind of how that came to be.
Yeah. And if you guys haven't, followed him on social media, definitely do it. He does put out a lot of content, a lot of good stuff out there. So make sure you give him a follow, make sure you look at his stuff. And yeah, I've seen a lot of stuff you put out. I mean, the video content's really good and very educational. And I think you do a great job at it. So let's switch gears, slightly here. Let's talk about some of the projects you've been involved with. I don't know if your role at Ashcroft is where you get into the weeds on projects or not, but maybe that should be the first question. Do you have like hands-on on the projects, or are you just more investor relations and project agnostic, if that makes sense?
Yeah. No, it's a good question. So just total out of coincidence, I'm out in Central Florida, and Ashcroft started about 2.5 years ago buying Orlando properties and Jacksonville and Tampa and Clearwater. So naturally, I have more involvement just because I want to have more involvement with those projects. But I'm not an analyst. I'm not an underwriter. I'm not out there seeking deals. And again, I'm not part of the GP team. So we're headquartered in New York City. So we've got Frank Rossler, Scott Lebenhard, and then Joe Fairless. They're out touring properties, doing the due diligence, doing the underwriting, things like that. So they're much more into the weeds than I'm just simply a LP investor with them. But I do have a lot of involvement, and I host a lot of property tours and things like that. If anybody listening is visiting the area or lives in the area, always happy to do that kind of stuff for you.
All right. What's the type of investment that you like to invest in as an LP? And what type of things is Ashcroft Capital purchasing right now?
Yeah. So for me, what kind of sold me on real estate in general, but specifically multifamily real estate from a macro level, is, again, I live on passive income. So that always has to be a component to the deal. So if it's going to be a new development or some, non-occupied building that someone's going to try to turn around, or some hotel conversion, I'm not going to invest in that if it doesn't cash flow. Number 2, the potential for equity upside. So I love doing value add business plans the most. And that way you can force appreciation in there. You're already buying something that maybe is 200 below market rents, and you're going to take it up to the market level. You get great tax advantages, even though bonus depreciation is phasing out over the next series of years. It's still very lucrative tax advantages. You can, of course, use leverage and debt and things like that. So to answer your question, both Ashcroft and any other group we're talking about that I've done a deal with is usually, I'm generalizing in a sense, but Sunbelt markets. And the only reason for that is I'm constantly looking, and they're constantly looking at migration trends. Where are companies and people relocating to, and why? We've seen a huge acceleration to the Sunbelt through the pandemic. You've got Texas and Florida being tax-free states. We look for diversification among employment, because at the end of the day, it's the ability for your renters to pay the rent. And if they can't, or there's no industry around them, or they're in they live next to a cruise ship port and the cruise lines go down because of the pandemic, then your multifamily can really hurt, So we look for that kind of diversification. Landlord tenant laws, stuff like that, school ratings, all kinds of stuff, So it's going to be a class B in most cases. So you got class A, B, C, D. And so A is like your luxury high-end new development. B could be a 1995 to 2010 or 15 built pre-existing product. Always going to be stabilized, cash flowing, high occupancy, high collections. So we're able to generate cash flow on day one out of the gate without having to lift a finger or do anything. So that's key to me. Conservative debt structure, 3 to 5 year time frames. That's how long it takes on average to do a full renovation to a 200 to 600 unit complex. And I like the option and the probability to sell to institutional buyers, whether it be a large Wall Street firm or a pension fund or an insurance company or a publicly traded REIT or something like that. That whole buying pool is vast and competitive. And then we also have side options. You could sell to another syndicator.
Yep.
You could sell to a family office. You could sell to a wealthy individual. There's a lot of options for your exit. So I always like that.
That basically means you're looking at larger properties when you're looking at exiting with, potential for family office or institutional buyers. You're talking, 200 units, 300 units, and probably 50 million and above on purchase price.
Yep, exactly. And not always central in a major metro. So if we look at, Dallas, Texas, maybe we're buying in Haltom City or we're buying in Fort Worth, or, it's usually a surrounding submarket and things like that. So institutional quality is what we look to achieve once we're finished with the renovation: strong bones, good structure, better signage, marketing, better amenities, modern updates, technology, solar, LED, just these kinds of things, right? We're just modernizing. And then we can compete with the newer properties in the area. You're not going to get the same rents as a Class A, but you can bump a rent from $1,400 a month to $1,600 a month and then look to exit at that point. So that's my favorite type of deal. That being said, I have done a lot of other types of models, but that's about 80% of my focus.
Yeah, I think there's a lot of security in that type of deal. And you hit a lot of wickets. Conservative debt, when you said that, what's your idea of conservative debt, and has that changed in the last year?
It has, kind of. It has and it hasn't. So I've always been a believer in either fixed rate debt. And if you're ever going to have adjustable, you need to have a plan B, which could be something like an interest rate cap, for example. And what we've seen in the last year, everybody knows, interest rates effectively doubled, but we saw that an interest rate cap, for example purposes, that you could have purchased for, say, 80 grand a year and a half ago is now $2 million, in some cases. So if you didn't plan for that, now you need to have $2 million to buy the same interest rate cap or extend it. So some people are getting in a little bit of trouble right now with their financing. I like to have a longer debt term than what we anticipate holding the property for. So if we look at a property and say, we'll be in and out of this in 2-3 years max, I want to see 5 to 7 years of debt term. That way, if we're in a recession, if something delays the project, et cetera, we have a buffer of time frame there. And on a related note, talking about cap rates, never mattered to me what year we were talking in. If we were buying at a 4 cap, I would like to see a projected exit cap rate at, say, 5, 5.5, something like that, to remain conservative and to anticipate either higher interest rates, softer market, or a pending recession or something like that. So those have always stayed true. I just pay attention a lot more, especially over the last 18 months, about debt and financing.
For the listeners, a lot of gems right there. I mean, the people who are in trouble right now or having problems right now didn't do the type of debt that he's talking about. The rate cap insurance keeps your payment from going above a certain point if you have a variable rate loan. And purchasing the rate cap is kind of a thing as well. It costs money to buy that insurance policy. And the other thing is the longer term debt. Had people 2 or 3 years ago abided by those principles, there wouldn't be very many people in trouble right now. But there are a handful of operators that are. But anyway, Travis, thanks for explaining a little bit more on that one. I think that was awesome. So appreciate that. Shifting gears a little bit more, let's talk about your motivation and your why. And you talked about it a little bit earlier, but if you could boil it down to a couple of sentences, what's your big burning why?
Yeah, I think what I spoke to earlier was the self goals. I wanted financial independence to leave a job I didn't like. That was my back when. What it turned into after getting to that point is sharing what's worked for me and trying to help others along a similar path. I never advocate people should do exactly what I do or did, but passive income can't hurt to have a little extra in your life, whether you lose your job or have to take some time off work or, pivot careers. It just gives you more options is all it does. And so even though you may not want to retire early or stop working, that's totally cool. But an extra $20K a year could get you a couple vacations or something like that. So that's what I help people do. That's my why today. And I give a lot of my time away for free. As you mentioned, the content I post, if you notice, there's not a sales pitch to any of it. I'm not out selling books and programs and courses and mentorship. I'm just out there saying, hey, here's a cool creative idea or strategy or something that I just did, and I'm sharing it with you. If you want to learn about that or how that works, then connect with me and let's chat. So that's what I do with a lot of my spare time that I never had before.
Love it. I love it. All right. Last question. What's next for you?
Wow. That's a good question. That's a deep one.
Yeah, it can be the hardest one to answer too. So
what's next? Yeah,
what's
I'm
next?
not, I always struggle with this question, when a company would ask you that and you're an employee, where do you see yourself in 5 years? Like, I don't really think in terms of that too much. So right now I'm just helping where I'm needed with Ashcroft. We're launching one fund per year. And we're putting 6 to 10 properties in the fund. We're raising rough numbers, 100 million a year. And investors are really liking that. It's a much easier process than what we used to do in the past. And it's exciting to have properties in my own, backyard, so to speak. So I'm really immersed in the moment right now. I'm really happy and content where I'm at. I'm going to ride the wave. It's wherever we head and whatever changes come our way, until one day it may not make sense. At that point, you pivot and you have the flexibility to do so because, you've been focused on passive income, right?
So I lied. I said last question, but I do have one more that you just brought up. Why the fund model instead of syndication? What benefits does that have? And why did you guys choose to go that direction?
Well, frankly, it's pros and cons. It's not all, there's no perfect anything, right? So let's talk about that. I'll start with the pros and then we'll move into the cons. So with a fund, you have broader diversification. So in the case of Ashcroft, we're buying in the Carolinas, Georgia, Texas, Florida. So you're going to be spread out with your investment. Okay. Very low minimum to enter into our fund, 25,000. So if you think about that, let's just say you put 100 in for that example. And, we have 5 properties. It's like putting 20K into 5 different deals. So that's still quite a low minimum and way to think about it. You have one place for the majority of the year to put capital. So investors, we all have, liquidity events that occur at different times. People are always exiting the market. They're inheriting money. They're selling a property. We don't know when that's going to come. They don't even know when that's going to come. The worst thing, like one of my biggest headaches when we were doing one deal at a time, was this investor reaches out and says, I have $1 million for you. What deals do you have? And we say, we don't have one right now. I'm sorry, but hopefully in the near future we do. And then in the near future, we do.
$1 million is spoken for already. Yeah.
There you go. Right. The competitor got the money. So it's a little more seamless. One set of docs. You can invest multiple times throughout the year. You get one consolidated K-1 tax form. It's just efficient. No stop and go and all these unknown factors. Now, to the cons, you have to put more trust in the operator. Okay. Because if they launch a fund in January and say, we're going to buy 6 to 10 properties, put this kind of debt on it, do this kind of leverage, these markets, you have to be fairly certain that they can do that, that they have a track record of being able to do that, or else it's like a blind fund, right? It's like, here's 100K and I'm just hoping you do what you say you're going to do. So there's more risk, especially in the beginning before they start acquiring properties, things like that. The second con is it's tough to conduct the full spectrum of analytical due diligence in a fund. Obviously, when they don't even have any properties in it, it's impossible to do it. But even if they're halfway through, you only know about 2 or 3 properties out of 6 to 10. You can't thoroughly do as diligent of due diligence.
Yeah, it's like you said earlier on, it goes back to trusting the operator.
It does. Yeah, no, it totally does. So yeah, that's just kind of the high level on funds. It's not for everybody. If you're going to be active or a GP, it may not make sense to do a fund right out of the gate. If you can't go out and raise $100 million or you never have, it may not be wise to say we're doing a fund. You might want to start with one deal at a time for a while and maybe move into some portfolio purchases or something. But anyway, each their own.
Yeah. Awesome. So if it works for you, do it. If it doesn't,
There you go.
yes, regular syndications work well too. So that
Yep.
said, Brent, how's it going?
Going well.
Good. Do us a favor, introduce yourself. Tell us a little bit about yourself.
Well, obviously my name is Brent Ufkes, and I am a licensed residential builder in the state of Michigan. I currently only have one single family rental, which the rehab is not even complete on.
All right. So you're a contractor right now. What do you do in that space?
So basically, I do mostly like bathroom and kitchen remodels.
Okay.
A lot of floors. I don't have a full crew. I'm a sole proprietor. I do most of my work alone. I have a couple guys that help me occasionally, but I basically just do like 1 or 2 full gut rooms at a time.
Okay.
Or whole house floors or trim or things like that.
Yeah. Sounds like the type of stuff you'll be doing inside of apartments too. So yeah. Nice. What has attracted you to real estate investing in general and apartments specifically?
So I would say probably early last year. Well, I worked for the same company for 17 years up until 2015. And then they reorganized the plant and I just kind of got booted out.
Yeah.
I don't have a college degree, so I didn't really have a lot of options. I couldn't find something comparable, responsibility and pay wise. So I decided to become a contractor. I had been working on houses my entire life with the old man. So I just thought that would be the best way to go to continue the quality of life that I was living. I've been doing that since. It's been great. But early last year, I twisted my knee, right? And then I met my mortality. And I said, well, I'm going to have to do something different because I don't have enough retirement. And I'm going to have to be able to have money coming in the next 10 years, or I'm not going to be able to retire and my body's going to fail. So that's when I started researching the real estate. I got gung-ho. I refinanced the house. I took out a HELOC. I bought a second property, and that's kind of where I'm at in the middle of. But I had a couple snags in the process, so I got a little bit of work to do before I can finish with my first deal. And get that profitable so that I can move on to step 2. And that's why I'm here now. I'm trying to figure out what the direction needs to be after I finish remodeling the first house.
Yeah. There's a lot of directions you can go, and I mean, I'm a lead syndicator, that's how I started with multifamily, and I ended up passively investing later. Travis had the opposite approach, was passive investing first. And hopefully we can answer some of those questions. But before we get to those, I'll ask you about your big burning why as well. And you mentioned a couple things related to it, but what's your motivation? What's your big burning why?
So really, I have 2 things. One, again, it's being able to retire before my body fails is number 1. And number 2 is I just want to be able to create an opportunity for my daughter to be able to retire before her time as well. So I've been trying to drag her along in the process.
All right. Well, I love it. Thanks for sharing. Well, here comes my favorite part of the podcast where I can sit back and listen to most of what's going on. So, Brent, we got Travis on the line. What do you want to ask him?
I actually had given you a couple questions, but as he was talking, I wrote down a few more. So I hope that's not a problem. So one of the things that you said you do is help people with the education aspect of it.
Yeah.
So right now I am basically a newbie investor. At this point, I'm non-accredited, and say I wanted to become in an LP role for somebody, and I save up the minimum. But I need to know that that's a good path for me. Where would you suggest I go for education to where I can learn the process through books or sites or seminars so that I can self-educate and make a better decision when I take the next step?
Well, great question. And there's a ton of sources and resources, and everybody kind of has their own take on this. Okay. But I'll tell you what I did. I started with open forums where I could communicate with other people online. So for one example would be, say, Bigger Pockets or something like that. You can read a lot of blogs and forums, you can ask questions, etc. That led me to conferences and meetups, both locally and nationally. So I've been doing those for years, and I always get a ton of value out of there. And you're always going to run into passive and active investors. And then you're going to get kind of the macroeconomic rundown at a lot of those events and stuff like that. Podcasts, of course, I run 2 podcasts myself, but I'm also an avid listener of podcasts. So what I started doing I have two different podcasts going right now, and I'm not up here to self-promote. I'm not selling anything, but under the Best Ever brand, so you can YouTube that or bestevercre.com. I have a show called Passive Investor Tips, and these are short, very consolidated, to the point episodes. They range from 5 to 10 minutes in length, and I just tackle one strategy or one topic per episode. It's a once a week kind of show. It's going to be 100 episodes long. And in my opinion, it's great training for somebody looking to become an LP. It's how to think about it, its mindset, its strategy, its philosophy. It's a lot of stuff. Under the Ashcroft umbrella, also on YouTube, I created a whole series called Multifamily Investing 101. And from there, I put a ton of terminology and, things that you'll need to understand in terms of how to conduct due diligence, or what cap rates are, or how to calculate IRR, or what syndicator fees are and how they work. I mean, there's a ton of episodes like that. So those are two additional resources that you can look up. But I have to say, this is the biggest answer to your question. Mentors have made the biggest impact in my life by far. I've read a ton of books. I've listened to a ton of podcasts, and there's my shows and stuff, but it's being able to connect with somebody face to face or over Zoom or over a phone call, and somebody who has done successfully what it is you're wanting to do. And it's somebody that you can ask a modern day question to. You can say, hey, it's 2023. The Fed just did this and 2022 was that. What should I do in this scenario right here? That's made the biggest difference. So there's paid coaches, there's paid mentorships, and then there's unpaid. Mostly I've done unpaid mentorships, and it's because I get organized with my questions like we're doing here on the show. And I just ask for 15 minutes of somebody's time, and I don't bug them very often. And so, and I spread that around to maybe 10 different people, and that gives me basically all I need to get my questions answered. So good question.
Nice. Good advice.
It
Thank
makes
you.
a lot of sense. And I agree. I think mentors have helped me the most, and it can be a very informal mentorship, but I would add, find people you trust in the industry as well. I mean, there's a lot to learn about it, but find people you trust in the industry. That's probably the next step, because you're going to have to eventually, in this multifamily world, most of the money comes in through, syndications, 506B, 506C syndications, or funds like Ashcroft. But eventually you're going to have to find the people as well. So find somebody like, and trust, and pepper them with questions too.
Yep.
Nice.
100%.
Yeah.
I haven't really done any research on this yet, but since you guys brought it up in this episode, I was wondering what the pay structure is on a fund versus a syndication.
Are we talking about GP and LP, or just?
I just mean like returns. Like if I'm an LP in a syndication, right? You get your quarterly checks and then a payout when they sell.
It's pretty much the same. Like, it's not like funds always pay you a higher potential return than an individual deal. All it is that you're getting the added benefit of diversification. So your cumulative distribution, whether it be monthly or quarterly, Ashcroft does monthly, a lot of groups do quarterly, is coming from a combination of, say, 7 or 8 properties. And then you're, say, a 1% owner of the fund. So 1% of that cash flow is getting flowed over to you. In one individual deal, it would be very similar. You might be a 1% owner of the deal, so 1% of its cash flow comes to you. On individual deals, this was another con that I forgot to mention about funds. I've been in individual deals that think of it like picking stocks. Sometimes you're right, sometimes you might be wrong, or something happens, unexpectedly to the property. But I've been in individual deals where we've doubled money in 3 years unexpectedly, right? They sold early and it did exceptionally well. It outperformed expectations. You're less likely to get that outcome with a fund, because you may have one deal do that, but then the likelihood of 7 or 8 all doing that is pretty unlikely. You're probably going to have one underperform, one outperform, and the rest kind of somewhere in the middle. So you're going to get a more stable and predictable return, but probably not those exceptional winners. But Brian, any thoughts?
Just to add on to what he said, with the multiple properties, you're probably going to have a more consistent distribution. With some of the syndications, we've had to pause distributions on a couple of our properties, but if you're in a fund that has 10 or 12 properties, one or two may have an occupancy issue, or you may have run into some operational problems that cause you to pause your distributions, or you just might be saving money up for that rate cap insurance that, quadrupled in price over the last year. But it's not as likely for that to happen over 12 properties, right? And so if you're like Travis and you're trying to live off your passive income, I think that consistency is more important than the potential home run for a lot of people. And if you're in a fund like Ashcroft's fund, your returns are probably going to have a lot less variance or a lot less variability than, an individual syndication might. And Travis mentioned the case where you might not see home runs, but a pro to that is you're not going to see the fund completely lose out either. There might be one loser in the fund, but if you invested in that loser as a syndication, I mean, your returns, are going to be, whatever that ends up being.
Yeah. The parallel again that I like to always think about is the parallel of stocks, because so many of us were educated on the stock market. So it's buying an index fund of stocks or a mutual fund or something versus picking the one stock you think that's going to do great. It's like, is the S&P 500 going to go to zero? Well, that means 500 of the biggest companies went to zero. Probably not.
Doomsday scenario. I mean, there might be some doomsdayists that predict that, but
yeah, maybe. I don't have a crystal ball.
Yeah.
Okay, this one might be a little cookie cutter, and it's something that you always see in the podcast that everybody asks. But I guess if there was one thing that you could tell yourself 15 years ago before you started to kind of progress your path faster or better or in a different direction, what would it be?
Two things, really. It's mentors, which cuts the learning curve tremendously. Even books, right? You think about somebody who wrote just a limited amount of books. Mm-hmm. They've done something in their life for 10, 20, 30, 40, 50 years. They're compiling everything they know and have learned into a book that you could potentially read in a month. So you go out and read 5 books a year, you're going to be way ahead of most people. And the best advice I ever got from a mentor was double down on what's working. So between high school and post-college, I'd probably launched 20 small businesses of different types. I used to do audio and visual stuff, and I had a car detailing business. I had a clothing line. They were all suffering. They were all doing crappy because I was not good at what I was doing. And when I got into real estate, it was the first thing that just clicked. It just made logical sense. It made fundamental sense. I could touch it, feel it, see it. It was the first thing that really was working. And so I doubled down on it. I made that my full-time focus. So those are 2 things.
I would say, if I were to go back 15 years, I've been asked similar questions, but what popped up in my head right now is I wish I would have been more comfortable being uncomfortable, and, in my career, I was active duty Marine. And so I was very accustomed to being uncomfortable in that role, but with my finances, I was not comfortable being uncomfortable. With my income, I was not comfortable being uncomfortable, so I was fine, walking around in 20-degree weather, with not a lot of cold weather gear and doing that all day long. With betting on myself and being able to make big moves financially, I was not comfortable with that uncomfort level. And so I stayed in my comfort zone in those areas.
Good one.
Nice.
Yeah.
I just got done reading Tax-Free Wealth. And historically, I do my own taxes, and I just bought the rental. And after reading the book, I realized that I need to have somebody else do my taxes. So do you have any advice on finding a good CPA?
Sure, I do. So I read that book probably in, 2015, 2016, around the same time I was getting into these multifamily syndications. But I had a lot of active real estate anyway at that time. That book probably single-handedly saved me approximately 50 to 60 grand right out of the bat, over the next 2-3 years, just thinking about some of those concepts. And to your point, finding a better CPA firm. So like Wheelwright and his firm, they're a proactive strategist firm. Okay. They're not the send me your paperwork at the end of the year and I'll tell you what the result is. they're with you throughout the year saying, have you thought about this? And are you using the Augusta rule? And what about your home office, this and that? And I've got a firm like that I use now. And again, maybe it sounds like I pay them a lot. I probably pay them like $3-4 grand a year. I don't know what I pay them, but they save me probably 25K a year in taxes just through doing strategy. So the key is this, and I'll use a non-real estate example too. When I worked in oil and gas and I started going overseas, I was based out of Colorado, but I was working full-time and exclusively in Saudi Arabia. My CPA was not even a CPA. They were a tax prep service that I had always used from childhood through them. They were filing my taxes where I was paying 100% tax as if I was working in the state of Colorado. I got a second opinion from a specialty group that specialized in overseas oil and gas workers. And guess what? We had to amend 3 years of taxes, and it saved tens of thousands of dollars when I did that amendment. So you got to find the specialist, whatever it is. If you're doing single family, multifamily, construction, development, oil and gas, you've got to find a CPA firm that is both proactive and strategy focused. And usually you pay the highest amount in year 1 or year 2 or something like that. And then it drops off and they want to retain you as a client, because that's most of the strategy. But I'll give you some answers offline. I don't want to promote these groups, but happy to share with you. And it's made a world of difference.
So I'll just piggyback on what Travis said. I found a specialist. Most of my tax-friendly income is coming off of real estate and specifically syndications. And the tax professional that I've used for a couple of years now has a lot of money invested in syndications, and so she has a vested interest in knowing, how to best structure things and how to find the right lines of code or whatever it is to minimize my taxes. And like you, I did my taxes for myself every year. I was a DIYer in a lot of ways. That's actually what my podcast tomorrow is about, going from DIY to, professionals. So it's fresh on my mind. But I took an IRS-led income tax course, a long time ago. And I took some community college courses. And I thought I was pretty smart on taxes. And so what I did is I went with her 1 year. I did my own taxes first. I didn't tell her. Okay, I did my own taxes first, and then I sent it off to her, and I said, I'm going to compare. All right. She got me about $6,000 more on my return than I was getting for myself. I had already zeroed out my tax burden, but she got me so many other things that I was just like, all right, you win, you're doing my taxes, forevermore as long as you're in this business. But in a lot of ways, Brent, I was like you, where I did my taxes every year by myself, and I was able to do fairly well at it. But going back to what Travis said, find somebody who's an expert in, what you're investing in, in what your income looks like. And proactive is huge as well. Somebody who's proactive and can help you set things up right. So anyway, that was just my, real world example of, what Travis so eloquently said. But there we go. Well, we are about out of time. One last question for each of you. Probably the last question. I might, change my mind a little later. But Travis, you get to go first. How can listeners learn more about you?
Sure. So I give my time away for free in 15-minute blocks. So my calendar, you can find it at ashcroftcapital.com/Travis and find a time that works for you. No upsell, no sales pitch. If you don't want to talk about Ashcroft, we don't have to. I spend time with people who are 18 years old, who are 70 years old, who are accredited, who are non-accredited, who are new, who are experienced. So just reach out. And if that's not your thing on the phone or Zoom, I'm on Instagram, I'm on Facebook, I'm on Bigger Pockets, I'm on LinkedIn, and the hashtag is @PassiveInvestorTips. Happy to help.
Awesome. And Brent, same question for you. How can listeners learn more about you?
Yeah, mine's pretty simple. The only social media I have is LinkedIn. So find me, you can find me there.
All right. I think that's where we found each other, right? LinkedIn?
Yes, sir.
Awesome. All right. Well, hey, thanks a lot, guys. Very much appreciate you coming on the show. And as always, I learned something today as well, and appreciate both of you for your time.
Yeah, Thank you, Brian. Thank you, Brent. Great to meet you, Brent.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.